managerial accounting, absorption costing versus variable costing. Now let's go back to our opening scenarios where we compared the income statement under situation A, where we sold 9,000 units and produced 9,000 units, and scenario B, where we produced 10,000 units and sold 9,000 units, and see if we can't explain what caused the difference in net operating income under the two approaches. Recall that in scenario A, our net operating income was $240,000, and in scenario B, net income was $285,000. So we've got a difference in income under these two different scenarios of $45,000 when in both scenarios we sold 9,000 units. Now, it's easy to understand why that would be confusing to someone. So how can we explain that now that we've looked at how we calculate product cost under absorption costing? Well, the difference in the incomes has to do with the relationship between the number of units produced and the number of units sold. And in situation A versus situation B, the number of units produced was greater than the number of units sold. Now, when that happens, and we're using absorption costing for assigning cost to the product, part of the fixed manufacturing overhead is what we call deferred to inventory. In other words, part of that fixed manufacturing overhead is not expensed. In the period in which the cost is incurred. Well, if it's not expensed, what happens to that cost? Well, remember what happened. Units produced was greater than the number of units sold. So that meant that ending inventory of finished goods increased. That is where that fixed manufacturing overhead is parked. That fixed manufacturing overhead is on the balance sheet in ending inventory. On the balance sheet in ending inventory. Now, let's look at the numbers again. In scenario A, change colors here. In scenario A, our net operating income was $240,000. Okay, which I'll just leave off the 3 zeros. And in scenario B, our net operating income was $285,000. Again, a difference of $45,000. Now, let's look at the fixed manufacturing overhead in scenario B, the period in which we produced more units than were sold. If you recall, the fixed manufacturing overhead was $45 per unit. That was the 450,000 divided by the 10,000 units produced. So $45 per unit was the fixed manufacturing overhead. Now, what was the change in the inventory level? In scenario B, we started out with 500 units, produced 10,000, sold 9,000. That left us with 1,500 units. So we started out with 500, but at the end of the period in scenario B, we had 1,500 units. So inventory increased by 1,000 units. If we take that fixed overhead rate in scenario B of $45 per unit and multiply it times the 1,000 unit increase, what do we get? 45 times 1,000, that is our $45,000 difference in income between scenario A and scenario B. So that's what happened. It's the accounting that yielded the difference in income, not necessarily operations.